Hi there folks, one of the most common questions or comments that I get asked by the aspiring trader or the rookie trader, in fact I'd go as far as to say most of the traders I speak to out there, is how do I avoid getting stopped out? Or it goes something like, I keep getting stopped out, then the market moves on almost the exact level and continues on the direction that I'd previously predicted, resulting in what would have been a winning trade. Really frustrating when that happens. Now if that's happening to you, you need to listen up. Today, we're going to look at probably the most basic but the most important form of technical analysis out there, and that's market structure. We're going to help you identify what market structure is, the different types of structure, and how we can use this in our trading. Understanding market structure and using it properly can not only help massively in our stock placement, but also be a very valuable tool when it comes to our trade planning and our trade entries. So get yourself a notepad, sit back, take notes, and enjoy. Come on. Okay, so let's talk about market structure, which I think is the key to all technical trading out there. So what is market structure? Well, basically, as you know, when we are trading the markets, we're always looking at different time frames. So it might be the 1 minute chart or the 5 minute, the 15-minute chart, the 1 hour, 4 hour, and what have you. Those different time periods are fractals. They're fractals of the bigger picture. It doesn't matter, even if it's the daily, it's a fractal of the weekly and the monthly. So it's important when we're trading that we understand what the market structure is behind the current time frame that we are looking at. The bigger picture tells the bigger story, the most important story. I often say, when you're going out in the day and you open your front door, it's not raining. Does that mean you leave your umbrella at home? No, you look at the bigger picture. You look at the forecast. You look to see, is it likely to rain later, to make your decisions. Exactly the same as it is when we are trading as well. We ought to see what the bigger picture is doing to make our trading decisions. More about that in a moment. Now, before I get into that, let me just talk about the 3 different structural types that we have in the markets. I'm sure most of you will be familiar with these. First up, we've got the uptrend. Now, the uptrend is when you are making a series of higher highs. Higher highs with a series of lower lows. All markets move in waves. No market just goes in a straight line forever. There always has the corrective wave as well. So you've got the impulsive wave, the big move, and then the profit taking or what have you comes in. That causes the corrective move lower. Now, as the market is moving up in this particular direction, what have you, these higher highs, when they are respected with a higher low, then that basically means that that is a structural point. So here, for example, you've got a higher high, and this corrective wave came into this higher high with this low here and respected. That shows you that the human behavior, the market participants, are respecting that level for the continuation of that trend higher. So that is basically an uptrend, a series of higher highs and higher lows. And of course, the opposite of that would be the downtrend, where you have your lower highs and you have your lower lows as well. So this market is trending down. And you see here, the market held some support on this impulsive move, the corrective wave, but then the corrective wave was matched by a level of lower high, which basically led to that continuation. So this here, this lower high, lower low, I should say, matched with the lower high, basically gives you reason to believe that that is a structural point on the higher time frame. If you're trading on the lower time frames, you need to be aware of these structural points. You need to be aware of what current state of play the bigger market is in. And of course, then you've got the consolidation market, where the markets are not making any higher highs or any lower lows or what have you. It's basically a market that's consolidating. If you're a trend follower, you need to know what the market structure is at the moment. Are you going to be trend following in that particular currency pair or trading entity if it's in consolidation? Of course you're not. You want to get the best edge and the best high probability trades. So you ain't going to be trading a consolidating market if you are a trend follower. It's important to be able to identify that as well. So let's now talk a bit about the break of structure. When I get onto the charts in a moment, everything will become a lot clearer. I just wanted to outline this before we jump into the real charts. So here you'll see we are in an uptrend. Okay, we're making a series of higher highs, and we're making a series of higher lows. And then we move, and this basically there would be our structural point that I've just pointed out to you there. So this higher high, the corrective wave, and then we had the impulsive wave, and the corrective wave respected the previous higher high. This is a level of structural interest. And then the market moves on, but now we failed to take out a new high. So we're now creating a lower high. This could be an indication that the market wants to turn back on itself. Then we have a lower low. So that low is lower than the previous low. And of course, we've got a lower high as well. That indicates now a break of structure. When we break this key level where buyers became sellers and sellers became buyers, markets were respecting this level. It now breaks that. That is a good indication that the market wants to turn back on itself. So again, these are very important levels that we need to look at. Certainly, again, not only for entry, but also for our stop placement. Remember, when you see a particular chart, as I say, they are fractals. Look at this zone in here, this impulsive wave to the upside. Now, this might be the higher time frame chart. For example, this might be a 4-hour chart. Okay, you can take that down there on the 4-hour chart. But in the 4-hour chart, the 15-minute chart could look something like that. So there's lots of activity going on the lower time frame chart, but we're still in a structural uptrend. But of course, we are seeing impulsive waves, corrective waves and moves on the lower time frame as well. If you're trading on the 15-minute chart, are you going to start getting out of the trade here because you're seeing this corrective wave? When you know the actual bigger picture is still in a solid uptrend. Surely the better place to be placing your stop would be when it was to breach a structural level on the higher time frame. So again, using structure to place your stops as well, very, very important. Understanding that the price action is fractal of the higher time frame charts is very, very important. We're going to jump on to the charts now. And if you're a little bit confused at this moment, hopefully all will be made a lot clearer when we see it in real price action. Come on. Okay, so this is the chart showing the Australian dollar against the US dollar. Now, with all my trading, I always use the top-down analysis approach. I call it the anchor chart. I use the higher time frame chart to look at price structure to help determine the direction of the trend and help determine where I'm going to get out of losing trades should that structure ever get breached. On this chart here, I've got the 4-hour on the right-hand side, and I've got the 1-hour on the left-hand side of the chart. Let me just expand this out now, make it a little bit bigger for you to see. I'm just going to plot now some market structure pathways so you can determine or help to see how this trend is developing up. Let's just pick it from the bottom down here, just by my shoulder, and you can follow my crosshairs. Okay, so here we start off with an impulsive wave. Impulsive wave creating this new high up here, pretty much in line with the previous high if you look left. Then we have the corrective wave. The corrective wave basically takes us to this new low down here, which is higher than the previous low. And then another impulsive wave takes us up to a fresh new high. And then the corrective wave pulls us back into a higher low. But the higher low, if you look again to the left of the chart, is in tune with this previous level up here. This is a structural point that is clearly being respected. Let's just continue on up now. You're seeing a new high up here, and then this low, a new low. It's a higher low than the previous low, but it's basically respecting exactly the same level that the previous high came up to in around here. That is a structural point. It's a structural point that the chances are, if we breach to the downside, I don't want to be in this market. So keep an eye on that structural level. Okay, and we make a new impulsive move to this new high up here, and then a pullback, and a pullback on the corrective wave comes back to pretty much where you had that previous high here. This again is another structural point. It's where buyers are becoming sellers, sellers are becoming buyers. Now I'm keeping an eye on these levels to determine when I'm going to exit my long bias, whether I'm in the trade or not, whether I'm going to start looking for sell trades only. The moment, while the market is forming these structural new highs, I'm only going to be looking for buy trades. Now this is real time. I would be looking at this move now, which basically takes another impulsive move but fails to take out the previous high. And then we're pulling back again now. As I say, this is real time. If we see a breach of this structure, that is where I want to be looking at placing my stops on the lower time frame charts. At the moment, I'm still taking trades to the long side. I appreciate that markets move in impulsive waves and corrective waves. That is the natural formation of trends. But I'm also respective that trends don't last forever. And when we see a break of this structure, that's when I would be considering to take, let's say, short trades or get out of any long trades. That's just one example there. Okay, so now if you drill down to the lower time frame charts, for example, here on the 1 hour, you'll still see we are in uptrend. You know, I'm only taking long trades because the structure is pointing up on the higher time frame charts. The market structure is pointing higher. I'll be looking for my entries on the lower time frame chart. But you'll see here are these levels of market structure applying on the lower time frame. That's telling you where I want to place my stop. I'm not going to get stopped out on all these little smaller gyrations on the lower time frame. I'm looking at the bigger picture to determine where I'm going to get stopped out, knowing that markets are moving all the time. Do I want to get stopped out here, placing a trade with a stop of only just 20 or 30 pips or so? Well, possibly, but the market structure, if breached down at that level, 74.50, will be much more significant. That's when it has a higher probability of turning around. Markets obviously are gyrating much more so in the lower time frame charts than they are on the higher time frame charts. Now keep an eye here on the right 4 hour chart. I'm just going to put a box around that 4 hour impulsive wave. Okay, and there you see it up there on the right of the screen. That basically equates to here on the left hand side of the screen. Plenty of opportunities to get into this trend on the lower time frame charts. I'm not getting stopped out on every little move to the downside because I know that market structure should keep me in the trade as long as we're above 74.50. And indeed, when we do get down to 74.50, we hold that level and off we go again. And that allows me to enjoy this impulsive wave again for trend continuation. Hope that makes sense. Okay, so I hope you found that useful. Maybe now you can implement some better stop placements out there. If you did find it useful, give me a thumbs up. Give me a thumbs down if you didn't. Don't forget to leave a comment. I do read them all and get back to as many as I can. Don't forget to subscribe to the channel if you don't already do so. Make sure you hit that bell notification. That way you'll be notified when the next video has been released, and apparently it helps us as well. You can follow us on all the socials, and if you want to come and join us in our regular daily live streams, you can also do so. Just head over to forexsignals.com. You can take out a trial and you can come and join us in our streams where you can interact with us and so forth as well, chat to me personally. Okay, thanks very much for listening. Hope you have a good week, and I'll see you next week.